Get some perspective on the markets. Tom Elliott is global strategist at JPMorgan Chase Bank, and he joins us now. Good to have you here, Tom. Let's start out with this U.S. debt debacle. How much of an impact is it having on equity markets?
I think it's having more on equity and risk markets than one might have expected. You would have expected the Treasury market to have been the first in the firing line, but that's been relatively secure. I think because a lot of the buyers of Treasuries feel there's nowhere else to go. We've been hearing about the Chinese disquiet, about seeing one of their big investments possibly under threat of default. But where do they go with all their money? They need to sterilize their dollar earnings. They buy dollars to get that currency, to get the dollars out of China to stop inflation. They send it off to the US. There's nowhere else they can go, really, without moving markets. Meanwhile, as a safe haven, the Treasury still has validity in a world of the euro crisis, fears of inflation in the emerging markets. Now, you talk about equities, and I'd also like to talk about some of the spread products in the fixed income, because I think that is where you are seeing the tension. And the tension is really almost an existentialist, because essential problem, we don't know what happens if the risk-free rate that goes into our capital pricing models suddenly becomes risk.
How do you calculate it?
Do we use the Johnson & Johnson AAA or Microsoft AAA, or do we just throw our hands in the air and say, we don't know, sell risk?
So it is reckless then, as Stephen Roach said. Stephen Roach said that one of the Chinese officials he's been speaking to says it's just reckless behavior.
It is reckless. I pity Mr. Boehner. He has been asked to do an impossible job, to lead the Republicans within the House of Representatives to the top of the hill, and then he finds that he can't actually lead the Tea Party up. They only want to go, well, they want to go on another hill.
You've said that this debt crisis is fabricated. What do you mean by that?
It's artificial. It would be absurd to have a default on US Treasuries that is entirely the doing of the politicians. There is no reason why America cannot continue to pay its debt. It has cash coming in by the oodles. There's no problem on cash flow to pay the debt. It would be entirely a man-made political decision not to pay. And I don't think we've ever seen a default based on stubbornness.
We do expect that the U.S. would come out and say that a contingency plan would be that bondholders would get their money, perhaps ahead of state or federal employees, rather. But let's say that this drags on for a little while longer and the ratings agencies do decide to downgrade the U.S. What happens then?
I'm not sure that it will matter all that much for the reason I've just given. Let's just stick to Treasuries. As I said, there's nowhere else for the big buyers to go. China cannot move into the North London property market as much as I would like China to. It would just move the prices up. So it has to go into Treasuries. There's no other market as liquid, as deep enough for them to put their foreign reserves. They can't. The euro isn't big enough. Gold isn't sufficient. You
see the U.S. Treasury yields right here, very much unaffected. We have seen something happening, though, with the dollar. The dollar, we used to see it as a bit of a safe haven play. When you had risk off, you'd get people going into the dollar. But now the dollar seems to be falling along with equities and commodities.
Yes, it's interesting. In the UK, in the Eurozone, we perhaps haven't noticed it so much, although it has appreciated. But where we've really noticed it is against the Swiss franc, against the yen, and of course against gold. And these are, if you like, proving to be very valuable, very useful safe havens. And of course, as we heard, the Swiss need this, they don't need it at all.
It's having
hindering export.
Ramifications around the world. Tom, we've just had some breaking news. Moody's has put Spain on review for a downgrade. It's a rating of AA2 on review for a downgrade. Is that surprising?
It doesn't surprise me. Spain has not got to grips with its principal problem, and that is a failure for supply-side reform, by which I mean the labour market needs to be freed to absorb that 45% unemployment of under 25s. If they don't do that, we're in an era of low growth. They are heading, I fear, for social tensions.
Now, they have done some things on the labour front. They have made some what some would call pretty significant reforms, but it's not enough.
They're starting from a position that was so constricted, so rigid. They need to do far more. It's not just reform on the pensions, which they have made progress on, reform on giving temporary workers a bit, opening up the labour market like that. They need to go much further than that.
What does all this tell us? You mentioned that Italy struggled to get a bond auction off yesterday. We've had the second bailout for Greece. We've heard from the European Union as to what they're prepared to do more to stop contagion.
Yep. The end game is either disintegration of the euro. By the way, you don't have one country leaving and the others staying, or blocks creating. The bond markets just won't buy that. You have disintegration of the euro, or you have economic and fiscal union. And that is where we think we are heading with this. So when the leader of the true Finns says the Finns get the feeling that somebody else is milking our cow, well, I hate to say this to you, but that is going to be the case.
We're going to see more of these big transfers from the north to the south, to the periphery. When you talk about contagion, though, and you talk about this moving towards more fiscal union, that's going to take some time, isn't it? What happens between now and then? Do we see a restructuring of Spanish, of Irish, of Portuguese debt?
We see crisis after crisis being resolved. There's a line from the song Hotel California: you can check out any time you like, but you can never leave. That is how European leaders will feel. They'll be flying to capitals to do crisis meetings, checking out to the hotel in the knowledge they can never leave this crisis. They'll be back the next quarter for another thing, and then another thing, until we get full fiscal and economic union.
Between this crisis here in Europe and the debt crisis that we're seeing in the U.S., which a former Bank of England monetary policy member said, look, it could be a Lehman moment for the global economy. What's the worst case scenario?
We are not as doom-laden as these are saying, partly because we've already discussed the US as a manufactured crisis that will get resolved. Bondholders are not, Treasury holders will get their repayments. We're absolutely certain about that.
Okay. Tom, we've got to leave it there. Tom Elliott of JPMorgan Chase, thanks very much for being with us.
Thank you.